Alright everyone, welcome to lecture 10 in the series. So we're almost through semester 1 completely. Next lecture is the final lecture. It's a summary lecture of everything we've learnt. So yeah, well done. Semester 1 is almost over. Thanks for putting up with me. Alright, so this lecture is called Debt versus Equity, lecture 10. Otherwise known as how to put money into your company without screwing yourself. Okay, so this lecture is about one of the most common quiet disasters, let's call it, that we see with business people and entrepreneurs, especially ones that are just starting out. So typically they'll start making money, you'll form a company, and then without really thinking about it, you'll start moving money between you, natural person you, and the company in sloppy ways, let's say. And it's that sloppy movement where problems start to form. So today we're going to make this really, really simple and get straight into it. There's only two ways that you can get your money into a company, into a separate legal entity, and this lecture is going to be especially important for people who own or control that entity, right? But in principle, there's only two ways that you can get your money as a natural person into a separate legal entity, right? So let's get into it. Those two ways are one, equity, right? And two, debt, right? So that's it. They're the two main ways that you, natural person you, can get money into separate legal person, separate legal entity, your company, right? So everything else is going to be some messy version of these two anyway, and under stress, the law is going to force it into one of these two buckets. So that's just the way it is. So the core idea of our lecture today, without sounding patronizing, but keeping it very simple and very practical, right? Money goes in, it gets classified. Money comes out, it gets classified. Okay, very simple, right? If you don't classify it deliberately, then someone else is going to classify it for you later, right? It could be your bank or your accountant or your bookkeeper, or worst of all, the tax office, right? So if they do the classification, then you lose control. They're not going to classify it in a way that's going to make you happy. They're going to classify it in a way that makes them happy, right? So throughout this lecture, as always, we're going to use mental models and examples, and we're going to use the same simple example throughout the entire lecture, and then we'll have some mental models at the end, everything on Substack as usual, right? So for this lecture, we're going to imagine a founder. His name is Sam, right? And Sam runs an e-commerce business, let's say, selling dildos on Amazon, same stuff, right? Okay, so Sam has his e-commerce business, right? So usual, Sam registers a company, opens a bank account. Sam is the only 100% shareholder of the company. He is also the sole director, and beneficiary. It's his company. Sam has set up this company to do e-commerce business stuff. Okay, so it's just started. The business needs cash to grow. It's got to run ads. He needs to hire contractors, subcontractors. Maybe he needs inventory, etc., right? So Sam decides to put $50,000 of his own natural person money into the company to fund this first stage of growth, right? So we ask ourselves, Sam asks himself, what is that $50,000 that he's put into the company? Putting in is not a classification. It has no meaning at law, right? So what is that $50,000 and how does it get into the company legally, right? So what is the legal classification, okay? Remember, there's only two options, okay? There's equity and there's debt. But how Sam classifies putting the money into the company is hugely important. What category is selected, what category he selects with his legal professionals and tax advisors makes a big, big difference, all right? So we'll start with equity, okay? So in plain language, with equity, you're putting money into the company and it's got permanent risk capital, right? So I'll put here risk capital. That is the way to think of it. Okay, so what does that mean in, let's say, plain English terms, right? You can think of it as Sam is buying more of his own company. All right, that's probably the simplest way to think about it. That makes sense, okay? So the equity, the money he's putting in, the $50,000, is not owed back to him, right? He can't just take it back whenever he feels like it because he feels like it, right? And remember from our previous lecture, right? Equity is last in line, right? So generally debt holders get paid back before people with equity in a worst case scenario. Say the company goes bust. So that's why it's risk capital. He's adding capital to the business and it is at permanent risk, right? So if the company fails, then he risks getting wiped out completely, right? Because remember, debt is a higher claim than equity, right? And we know from our last lecture, please go back and watch it. All the lectures build on each other. We know from our last lecture that what you call assets or property, right, are just things of value with competing legal claims, right? So property is not the thing. Property is the claim, all right? Please go back and watch the previous lecture. All right, so back to Sam. So what does this all mean practically, right? So Sam puts $50,000 in as equity, okay? So if the company later fails, Sam can't say to the company, remember the company is separate to him, if it fails, he can't say to the company that, hey, pay me back my $50,000 first, right? But at the same time, it also means that by putting $50,000 as equity, he's, in a way you could think of him as strengthening the company, right? So now the company has more capital, it's got more buffer, it's got more runway, it's got cash, right? Because the equity is not a loan, it's not debt, it's risk capital, okay? So we're going to run through it as legal events is how we do it. Remember, we're building on knowledge from previous lectures, okay? So what are the legal events here? All right, well the first step is that he makes the decision to put the $50,000 in as equity, right? So he consults with his lawyers about the decisions, they discuss the implications, they get a valuation on the company, they decide how to do it, they decide to issue new shares, him and his lawyer go back and forward. So this is all the pre-planning and the planning stage and the decision. And we know from our previous lecture, right, that these are not legal events, right? Planning is important, do it as long as you need to, but planning is not a legal event. There are no legal events in planning, right? So what is the first legal event? Well, it would be an internal approval, right? So the company would approve equity, it would approve the new share issuance, okay? It would approve issuing new shares to Sam. Now remember, Sam controls the company, but he is also the natural person giving his money to the company. So that approval would be signed by Sam on both sides, right? So the lawyer would do the formal approval, the company would draw up the document, Sam would sign as the natural person, purchaser of the shares, and he would also sign as the signing authority for the company. So he would sign both sides and it would be approved. The company would formally approve to issue new shares. Okay, so that's the first legal event. That's legal event 1, right? Okay, so what's legal event 2? Okay, so the lawyer in the planning stage has done an agreement to issue new shares. So that would be legal event 2. They would sign the agreement. So the share issue would be signed. Okay, so that's legal event 2. Again, Sam is the signatory on both sides. He is the one taking the new shares, and he is also the one who's approved by the company. He's the sole director, it's his company, to sign to approve the issue of the new shares on behalf of the company. So the share issue is signed, okay? The share agreement, whatever you want to call it, the formal legal document issuing the shares, is signed by Sam on both sides. Okay, so what's legal event 3? Okay, legal event 3 is that the funds transferred. So Sam pays for the new shares. Okay? Okay, so that's legal event 3. So Sam has the shares and then he sends his personal natural person money to the company to receive the new shares, right? All right, so what's legal event 4, right? Well, you'd have the new shares formally issued and the register update. So shares formally issued. Right, so we're thinking in legal events, like our previous lectures. This is a transaction that he's doing. He's putting $50,000 into the company as equity, so this is a transaction. So it has legal events. Go back, watch the previous lectures. Share issue plus register, okay? So it's a register update in whatever jurisdiction he's in, and that's legal event 4. Okay, so what's event 5? What's the next legal event, right? Well, the next legal event is you would have the company's books would be updated, right? So you would have legal event 5, books updated. Okay, so the bookkeeper would formally recognize in the accounts the new share issue, right? And the bookkeeper would record it in the company's accounts as equity. Okay, now remember, Sam owned 100% of this company before the new shares were issued. So he has more new shares, but he still has 100% of the company, right? So the company's equity is up by $50,000 and its valuation is typically up because of the new cash in the bank, okay? But he still owns 100% of it. We're going to go into more detail about this kind of thing, about the accounting implications of it in a bit more detail in a practical sense in semester 2. But now he's got more shares. He still owns 100% of the company. The company has $50,000 of cash sitting in its bank account. So what is the new state, right, of after the transaction and all the legal events, right? So Sam has an additional number of shares of some amount based on the valuation of the company, right, which he did in the planning stage, right? So he's got an additional some amount of shares, and yeah, he's the 100% shareholder. The company has $50,000, and most importantly, it would say there's no repayment obligation now, right? Because he didn't do it as debt. So the company doesn't owe anyone anything, okay? It just has more shares outstanding, okay? So what else can Sam do? He can choose to do instead debt, okay? So if Sam chooses to stick the money in as debt, right, then that means that the company owes Sam money, right? Remember, companies and people are separate, right? Companies are separate legal entities to people, right? So the company would owe Sam $50,000, okay? So in plain language, you're not buying more company if you do it as debt, okay? You're acting like a lender would, right? So you would say, I'm lending. Sam would say, I'm lending the company $50,000, okay? And this means the company has to repay that loan, and it has to do it on real commercial terms, okay? It has to repay the loan, and it has to enter into the loan on real commercial terms, both Sam and the company. It doesn't matter if he owns 100% of it. He must conduct the loan with the company on real commercial terms. Okay? Remember, debt is a higher priority than equity. So if the company fails, the lenders get paid before the equity providers, the owners, right? So option B, right? 2, Sam puts $50,000 in. He puts $50,000 in as a loan, okay? So this means the company has an obligation now, right? It owes Sam $50,000 and it has to be on real commercial terms. So it owes him $50,000 plus interest as well, all right? And this is the key point practically. Remember, we deal with practical matters. If Sam takes out, say, $10,000 later and he calls it a loan repayment, that can be legitimate, right? Whereas equity, he can't just pull that $50,000 out whenever he wants. As a debt holder, he can pull it out and it can be legitimate for it to be a loan repayment. But the loan has to be real, right? So what does that mean? What is it for the loan between Sam and the company for it to be real, right? It has to be documented. It has to be recorded. And Sam has to behave consistent with it. And so does the company, right? That's very, very key. The behavior has to be on the facts and circumstances every day as time goes on, consistent with real commercial terms, with the real commercial terms of a real commercial loan. All right, I think you get the point. So we'll go through the debt legal events. Okay, so the first step, as usual, is the planning and the decision. So Sam's decided to put the $50,000 in as debt, okay? But he's going to discuss it with his lawyer, okay? He's going to instruct his lawyer to do a loan agreement. His lawyer is going to bring in the tax advisor. They're going to discuss the implications of doing it as debt versus equity, right? There are no legal events yet, just planning, okay? So what is the first legal event, right? So the first legal event is going to be the same legal event. It's going to be some authority or some approval, like previously. So an internal company, let's call it authority, right? So the company is going to approve the taking on of the debt. Sam is going to sign on both sides. He's going to sign as the lender of the $50,000 and he's going to sign as the authorized signatory of the company that is taking on the debt. Again, Sam is going to sign the company authority to take on the debt, both as himself, as the natural person lending the money, and he's going to sign the other side of the document as the person, as the representative of the company who's taking on the debt, okay? So what's the next event? Okay, so you would, the lawyer's drawn up a loan agreement in the planning stage, so you would sign the loan agreement, okay? Just a simple signature, right? So it would be this loan agreement's basic loan terms, the agreement signed, and you have to remember this, the loan agreement is on arm's length terms, right? So this is the kind of loan you'd agree with a real stranger in the marketplace, not a friend or a relative or a company that you control, okay? It's what you would do, it's what you would agree with a real person you don't know in the marketplace, not with someone you know or something that you control, right? So it has to have a fair price, normal commercial conditions, no special favors. Interest rate has to be usual in the marketplace, no special interest rates, okay? So what's the next legal event? One here, internal authority, loan agreement signed. What's next? Well, Sam would transfer the money to the company. So you'd have a funds transfer. All right, so Sam would transfer the $50,000 to the company. Very simple. Okay, what's event 4? Well, the bookkeeper would record it as a loan payable. Loan payable, and it would go in the company's accounts by the bookkeeper. The company now has a debt. It has a loan to be paid to Sam, right? So what's the overall state change here, right? Well, a creditor relationship now exists, right? Sam is a creditor to the company, okay? The company now owes Sam money, all right? So but that's, I mean, I think you get the idea. The thing in a practical sense that most business people tend to get wrong in actuality is they won't do A or B. They won't do one or two, equity or debt, cleanly, okay? So they'll do this third thing. This is what we see a lot. So this messy third thing, they'll pay company costs personally, or they'll move money in and out whenever they feel like it, or they'll use the company card for personal things, right? And then they'll think, oh, I'll figure it out later, okay? So we'll call this third option for fun. We'll call it messy. We'll call it the later base. They will stick it on the later base. All right, so there you go. That is the standard third one that new entrepreneurs especially tend to do, right? Look, honestly, in a practical sense, we've all been there. In a practical sense, in business day to day, it's sometimes unavoidable. Things get crazy, things get hectic, and yeah, sometimes you have to stick it on the later base. But don't forget and don't leave it too late, right? It's gonna have to be debt or equity, okay? Because under stress, it's gonna collapse. So get it done properly before any major stress events. We get it. The later base is sometimes unavoidable, but get on top of it, right? Before any major stress events. All right, so why? Why does it matter that you classify, whether you classify it as debt or equity, right? What is the big deal there? Why would you classify, why does it matter whether you classify it as debt or equity in a practical sense, right? So there's four main reasons, right? So the first one is priority, which we've been through a little bit already, but we'll go into more detail. The second reason is tax, always tax, right? And then you've got disputes, right? And we're going to go into each of these in more detail. And then the fourth one is credibility, right? So, and that's got two elements to it. So they're the four reasons, which we'll go into in more detail as to why it matters whether you classify it as equity or debt in a practical sense, right? So priority is really about when things go wrong. Tax is really about the treatment of the money both in and out and its implications for the company and for Sam. Remember, different classifications change different tax outcomes wildly, right? And then disputes are what happens if partners are brought on or investors are brought on, etc. And credibility, I think what people don't understand practically about credibility, which isn't brought up enough, is that the whole point of this practically is that so you can understand the law so that you can interface better with higher level professionals. When you do that, you can do more valuable transactions at a larger scale and grow your wealth. Remember, the law understands business as transactions. So to grow your wealth in your business, you're going to have to do more complicated and larger and more valuable transactions. In order to do that, you're going to have to work with the best legal professionals, accountants, and tax advisors, right? If you don't have any credibility, you're not going to be able to hire them and you're not going to be able to work with them. And you don't have any credibility if you don't understand these basic concepts. If you can't put $50,000 in a company as equity or debt and have a basic idea of what's going on, it's going to be difficult to have credibility with the kinds of professionals that you will need to work with in order to do more valuable transactions. So you won't be able to grow and grow your wealth. That is often underappreciated about credibility, and I think it deserves a special mention in a practical guide like this. So yeah, that aside, we're going to walk through each of these 4 points as to why this is important, right? And we're going to explain them. So first is priority. So yeah, we've been through it a bit, but basically when a company fails, everyone's going to line up. And the law is going to be concerned with who gets paid first, right? In most systems, we're jurisdiction agnostic here, but in most systems, the order roughly is secured creditors. So they're people who have lent their money to the company and have a special agreement that says they get paid back first. Then number two will be unsecured creditors. They're people who lent their money to the company but don't have any special agreement. They're just normal lenders. And then last on that list is owners, equity holders, right? So if a company fails, there is an order of operations. There is a priority list. And if you've classified it properly as debt, you're going to be higher up on that priority list than if you classified it as equity, okay? Now, debt puts you ahead of the line, basically, and equity is going to put you towards the back of the line. So in our example, if Sam funds the company with a real loan at arm's length, remember, and on commercial terms, and he behaves with the company and the company behaves with him as though that loan is real and commercial and arm's length, right? If he funds it as a real loan, right, then he has a higher claim if anything goes wrong. But if he does it as equity, right, then he's going to be last in line if the company goes bust. All right, the second reason is tax, okay? So new business people will tend to think that money's money, right? Okay, so the law doesn't think like that, obviously. It's most interested with classifying reality, okay? What's actually happening here and what is it classified as? So if Sam takes money out and calls it a loan repayment, but he doesn't have an actual loan agreement, right? Then the loan risks, the money out that he's taken out, that he calls a loan repayment, gets or runs the risk of being reclassified as something else. And that's where the pain begins, right? So say, for example, Sam takes $30,000 out, right? And he says, I'm just repaying my loan, right? But there's no formal loan agreement. There's no loan ledger. There's no consistent repayment behavior. There's no formal authority or approvals in the company documents. There's nothing, okay? So under stress, it's possible that someone like the tax authority will say, actually, that's not a loan repayment. And then the question becomes, well, what is it then? Well, it could be a dividend that Sam took, or it could be a salary that he took, right? And each of those have vastly different implications for both the company and for Sam from a tax perspective, all right? So different labels for transactions have very different consequences, right? So most important, that decision will be made at some point and it will be made for you later, right? If you don't do things properly, you'll give up your right to choose, basically. Okay, the third point is in the event of disputes, right? So Sam is the sole director, he's the sole shareholder, he thinks to himself, who cares, it's all my company, right? He didn't watch our lecture series, he didn't understand the difference between legal persons and natural persons, and so he thinks to himself, it's all my money, whatever, who cares, right? He doesn't understand companies and people are separate, okay? But he doesn't have a co-founder now. But disputes can come later from maybe he takes a future investor, or maybe he takes a future partner, or he goes through a divorce, or there's another lender, another creditor that he has to take, right? So there's another party that shows up in the future. And that's when the formal legal events and the documentation matters, right? And the classification, debt or equity, right? Because it changes the story of what happened, and the story affects the outcome. So a basic example would be, Sam brings on, let's say he brings on a partner, right? Or he sells part of the business. And then he says, oh, by the way, the company owes me $50,000, all right? If there's a clean loan, right, he's followed the processes and everything, it's great, it's visible, it's real. But if he didn't go through the legal events, right, he just sent the money to the company, called it a loan in his head, right, then that partner that he's brought on could say about him pulling the money out, that's not a loan repayment, that's money you're trying to pull out before me, for example. So it's the same money movement, but very different negotiation. Okay, so the fourth point, credibility. Apart from what I mentioned as a practical point as to credibility, if we look at when, say, a stress event happens, nobody really cares what you meant, okay? They care what you did and what you can prove. So if you funded it as debt, for example, then you need loan paperwork and bookkeeping. And if you funded it as equity, you need the equity properly recorded, right? Here, that's the last legal event here, legal event 5 here, right? Properly recorded. But if you just funded it with vibes, you just sent it in, right? And it's equity, whatever, right? Then you have nothing but vibes, right? What do you actually do as a founder, right? Practically. I think a simple rule, right? You choose the bucket first and then you move the money as a matter of basic principles, all right? Obviously, practically consulting with your professionals, but in principle, choose the classification, then move the money, right? And then through time, behave consistently with whatever choice you've made so that you build up over time a set of facts and circumstances to support your choice, right? So we'll get to a mental model now. We'll call it the minimum viable version of doing each. Obviously, this is not legal advice. This is a mental model and a framework to help you think through these issues properly in anticipation of working them with your lawyers, with your accountants, with your tax advisors, right? So for equity, the beginner version, basically, step one would look something like this in a mental model. Step one is you would decide this is equity, right? You would plan around it. You confirm the implications of your choice with your lawyers and tax advisors. Step two is you would transfer the money, you personally, as a natural person. You would transfer it to the company account, right? Then you would have your bookkeeper record it as a capital contribution, as equity, right? And then it would stay there as risk capital, right? If you want to move the money out later, you can't just grab it. You have to pay it out through a clean channel. We're going to get into that in a later lecture in semester 2, so stay tuned. But that's it, really. That's the basic process you're looking at. Equity's boring. That's why it works, right? All right. So for debt, okay, so basic mental model version. You need 3 things, right? You need a written note or a document, a loan agreement of some kind that says, some sort of document that says it's a loan, right? You need a basic record in the company books. And you need, and this is key, behavior over time consistent with a loan, with a full arm's length commercial loan agreement. You need a pattern of behavior, right? So for the loan agreement, get your lawyer to work on it with you. It can be very simple, just a basic amount, date, who's lending to whom, interest rate that's arm's length and commercial, right? Keep it arm's length, right? And then the company's accounts and ledgers will show that there's a loan payable to you, a loan payable to Sam in our agreement, $50,000 plus interest, right? Interest at normal commercial rates. Then you've got something real, okay? So debt behavior, again, is where business people tend to mess up, especially if they're new, right? If this is their first time dealing with such matters. So if you say it's a loan, right? You have to act and treat it like a loan over time. You need to create facts and circumstances over time that show it is a loan, right? So that means repayments are recorded as repayments. Repayments are not random whenever I feel like it, right? You don't call personal holidays loan repayments, for example, would be obvious thing not to do. If you generally, from our previous lectures, you know, if you treat the company like your wallet, your loan will be treated like a fiction, right? The law doesn't care about anything but behaviors, realities, facts, and circumstances. So a simple decision model you can use. If you need the money soon, after putting it in, so to say, the company, then it's a loan, it's debt, right? You document it. If you don't need the money so soon, then it's equity, right? Keep it simple. If you're not sure, pick one, document it anyway. If you're mixing it randomly, stop it now, clean it up, right? The goal in semester 1, which we're almost done with, is not perfection. It's clarity, okay? So, what is equity in summary? So, equity is, what do we know about equity? 3 key things. It is risk capital, right? So we've got it here, risk capital. What else do we know about equity that is important, right? Well, it's priorities probably. Yeah, it's last in line. Priority is a super important one. It's last in line, right? Is there anything else important that we know about equity, right? Well, as opposed to debt, it's not owed back to you. I think we've made that pretty clear, all right? So what do we know about debt, right? So debt is a claim, right? It's a claim on money back from the company, at least to start. It's the highest priority. It's certainly higher priority than equity in most jurisdictions, right? And most importantly, it must be real, commercial, documented, and arm's length if you want to be safe, okay? Then you've got the messy method, the later-based method we called before. Sometimes unavoidable in the chaos of entrepreneurship practically, but it will collapse under stress. So, key takeaway from this lecture, it's definitely not be an accountant. That's not your job. We're here to teach you practical matters to help you interface better with your legal professionals and accountants, right? So the takeaway is not to be an accountant, right? If you want to be an accountant, go for it. But that's not the point of this lecture. The takeaway would be, don't let money move between you and your company without a clear label, right? Choose the bucket first, document it, and then behave consistently with it.